Good evening. Happy Sunday. Welcome to our Sunday evening, all about mortgages, right? So today, obviously, um, home prices are out of control, right? And except for certain markets across the U.S. where, things have shifted a little bit and there's more inventory out there, for buyers to choose from, right? So buyers to have more of a leverage in the marketplace and the ability to find properties that suit their needs, especially for first-time home buyers, which, that market segment has been really struggling as of late. Now, um, with our mortgage company, we have some options to help, here in our market, leverage our capital to make cash offers. And that's been huge for a majority of our clients who have the liquidity to do so. However, unfortunately, if you're, using, down payment assistance, and we're not able to help there. However, if you do have the liquidity, this is a way for you to gain an advantage in the market where there's tight inventories, right? So right now, as it stands, if you're not using our platform um, in the marketplace right now, there are some ways to get lower than market interest rates, right? Um, one of the couple of the options, are going to be, if you have a 5-year plan, if you plan on staying in the home for 5 years, you can either do a 5/1 adjustable rate ARM, and here's why it works. It's a fixed rate for 5 years, then it adjusts annually. Lower initial rates compared to a 30-year fix. This is going to save you money if you sell or refinance within that 6-year period. And it's ideal if you're confident you'll move or refinance within 5 years. For example, 5/1 ARM at 5.5% for 5 years versus a 30-year fix at 6.5% could save you thousands on interest. There's also a 15-year fixed rate mortgage. Why it works, it builds equity 3 times faster than a 30-year loan. Lower total interest paid over 5 years due to shorter term. Best if you want predictable payments and you plan to stay slightly longer than 5 years in the home. The trade-off here is there will be higher monthly payments um, as opposed to doing a 30-year fixed or an ARM. Now you have your standard 30-year fixed rate mortgage, I should say. And why that works is you're going to have the lowest monthly payment. It frees up your cash for investment or other goals. There's also the flexibility to sell or refinance anytime without penalty. Safe choice if you're unsure about moving, or any life changes where you have to relocate for your work and things like that. The downside here is that you're going to pay a ton more money in interest rates over the, beyond the 5 to 7 year period. And there's also four hybrid loan options, such as 7/1 ARM or a 10/1 ARM. And why it works? Well, it's a fixed rate for 7 or 10 years, then it adjusts. Good compromise if you want a longer safety net in case plans change. Slightly higher initial rate than a 5/1 ARM, but lower than a 30-year fix. Another option, which I think is probably your final option here, would be an interest-only mortgage. These I kind of recommend for investors so that they can take advantage of more cash flow, yield more cash flow on the property for the next, 5 to 10 years, and then they can convert it to a 30-year fixed rate, down the line when things get a little bit better as far as interest rates. So one of the reasons why this works is that, for the 5 to 10 years, you're gonna have, obviously, like I said, have that lower monthly payment. It frees up cash. If you are an investor, you're gonna look into, you know, buy other properties, right? And then if you plan on, refinancing later on. The risk here requires a solid plan, down payment and principals, or sell before the interest-only period ends, right? And my final recommendation here, if you choose a 5/1 ARM, if you're certain to sell or refinance within 5 years, opt for a 15-year fix if you prioritize equity building and can handle a higher payment. Take a 30-year fix if you value flexibility or want a hedge against staying, in the home longer. And a pro tip here, use a mortgage calculator to compare total cost, interest, and fees over a 5-year, each option. Example. So for example, a 400,000 loan at 5.5, that's 110,000 over 5 years. The same loan at 6.5, 30-year fix will cost you 128,000 over 5 years. Let me know if you like, help crunching specific numbers. You can definitely reach out to me. My links are in the bio. Please like and subscribe. Right now with tariffs looming, and obviously China, is holding off on, well, they're not buying our treasury, selling treasury. So we'll have to see what happens within the next few months. The Feds do plan, inflation is about 2.3% right now. So I know the Feds are planning to, make 2 or 3 additional cuts this year. So depending on how they feel, so we'll see how that goes. And stay tuned. Please like and subscribe. I appreciate that. And we'll see you next Sunday. All right, take care.